What's up, everyone? Winston here, January 30th, 2026. A single day, one name announcement. And boom, $600 billion vanished from precious metals markets before people finished their morning coffee. Gold crashed 11%, silver absolutely cratered 31%, the biggest single day wipeout since 1980. Now here's the crazy part. This wasn't some economic disaster or financial crisis. This was a nomination. Trump picked Kevin Warsh as the next Fed chair and markets completely lost their minds. But if you think this crash means gold and silver are done, you're missing the entire point. In the next 10 minutes, I'm going to show you why this sell-off actually reveals something way more important than the price drop itself. Why the forces driving precious metals haven't disappeared, they've just changed the drivers, and what this means for your money in 2026. Stick with me because the truth behind this crash changes everything. The crash explained. Alright, let's break down what actually happened. Gold was trading at $5,600 per ounce. Silver hit $121. Both absolutely ripping higher throughout 2025. Then January 30th hits. Trump announces Kevin Warsh as his Fed chair nominee. Within hours, gold drops to $4,700. Silver plummets to $79. Institutional money bailed so fast it looked like a controlled demolition. Now most people see this and think, oh, precious metals rally is over, everyone's selling. Wrong. This wasn't retail panic, this was institutional repricing of one very specific risk that had been driving metals higher for over a year. What risk? Political capture of the Federal Reserve. Throughout 2025, markets were terrified Trump would nominate a loyalist, someone who'd cut interest rates whenever Trump demanded it, someone who'd fire up the money printer for political reasons regardless of inflation data. Hat fear. That specific scenario of Fed independence collapsing drove defensive positioning into gold and silver. Investors were basically saying, if Trump controls the Fed, the dollar's credibility is toast, I'm buying hard assets. Alsh's nomination killed that fear instantly. Why? Because this guy has a 15-year documented record of defending Fed independence like it's a religion. Back in 2010, he literally told his colleagues that if the Fed lost independence, the costs would be incalculable. Higher inflation, lower living standards, a currency that risks losing reserve status. Markets looked at Walsh's track record and said, okay, the worst case scenario just came off the table. Political capture risk, gone. But here's where it gets interesting, and this is what most analysts are completely missing. Eliminating political capture risk doesn't eliminate the other massive forces that pushed gold to $5,600 in the first place. Who is Kevin Warsh? The critical background. Let me tell you who this guy actually is, because understanding Warsh is critical to understanding where metals go from here. Kevin Warsh, 55 years old, former Morgan Stanley banker. In 2006, at age 35, he became the youngest Federal Reserve governor in the institution's 113-year history. Not a PhD economist, a markets guy who understood Wall Street from the inside, the leverage, the collateral chains, the funding mechanisms academics completely miss. Ben Bernanke made him the Fed's primary liaison to financial markets during the 2008 crisis. He was the translator between the ivory tower and the trading floors when the entire system was seizing up. Here's what matters. Warsh never cast a single dissenting vote during his 5 years at the Fed. Zero. He participated in every QE program, every emergency facility, every crisis intervention. But his private writings tell a completely different story. September 2009, unemployment's at 9.5% and climbing. Warsh warns the Federal Open Market Committee if policymakers insist on waiting until the economy has plainly returned to normal before withdrawing support, they will almost certainly have waited too long. He feared the Fed was building inflation risks that wouldn't show up immediately in the data. Sound familiar? That's exactly the pattern we're watching now. Wholesale inflation hit 3.47% annual in Q4 2025, while everyone's focusing on lagging consumer metrics. Warsh saw this coming 15 years ago. In November 2010, the Fed's debating QE2. Warsh tells Bernanke directly, if I were in your chair, I would not be leading the committee in this direction. If I were in the chair of most people around this room, I would dissent. Then he voted yes anyway, out of deference to Bernanke and institutional consensus. Remember that pattern. Personal conviction takes a backseat to institutional pressure. That's going to matter when Trump starts demanding rate cuts. Now here's where Walsh gets really interesting. The Walsh of 2010 was a hard money hawk. CNBC called him that explicitly. He wanted to withdraw stimulus early, feared excessive inflation, resigned from the Fed in February 2011 because he disagreed with the direction. But the Walsh of 2026, he publicly supports rate cuts, told Fox News that cutting rates could position the economy for acceleration. That's not hawk language. What changed? His AI productivity thesis. Walsh believes artificial intelligence is raising the economy's speed limit, the rate at which it can grow without generating inflation. If productivity gains from AI are real, you can cut rates without risking price stability. Treasury Secretary Scott Bessent shares this worldview. The alignment isn't accidental. Bessent reportedly directed Walsh's interview process. But here's the conditional part that everyone's ignoring. If those productivity gains don't materialize and inflation stays sticky, Walsh would likely pivot to a more hawkish stance. And guess what? Inflation is sticky. Core PCE at 3% in December 2025, 50% above the Fed's 2% target. Core Producer Price Index accelerated to 3.47% in Q4. Walsh inherits a Fed facing the exact conditions that trigger his hawkish instincts. The question isn't what he wants to do. It's what the data will force him to do when the productivity thesis doesn't materialize fast enough. The mechanisms that haven't changed. Okay, so political capture risk is off the table. Walsh won't be Trump's puppet. That explains the crash. But now let me show you the 5 structural forces supporting precious metals that didn't disappear on January 30th. Force number 1, central bank accumulation. In 2025, central banks purchased 850 to 900 tons of gold. That's 26% of annual mine output, 3 consecutive years exceeding 1,000 tons. World Gold Council surveys show 95% of central bankers expect to increase gold reserves over the next 12 months. This isn't temporary positioning, this is structural diversification away from dollar reserves driven by sanctions risk and strategic rebalancing. China watching what happened to Russia's frozen dollar reserves. Countries realizing the dollar can be weaponized. Walsh can't reverse this trend. He doesn't control geopolitics. Force number 2, fiscal sustainability. The federal deficit hit $1.88 trillion in fiscal 2025, 6.1% of GDP. Trump promises tax cuts, defense spending increases, infrastructure investment. There's no credible path to fiscal consolidation, none. Now here's the kicker. Walsh defending Fed independence actually makes this worse for the dollar long term. How? Because if the Fed won't monetize deficits through QE, that pressure moves to bond markets and currency debasement through fiscal channels rather than monetary ones. Same destination, different mechanism. Force number 3, inflation persistence. Core PCE at 3%, PPI accelerating. Sticky services inflation that rate hikes haven't broken. Walsh can talk about AI productivity all he wants, but the data keeps printing hot. Force number 4, geopolitical chaos. Ukraine, Iran, US, China competition, supply chain fragmentation, trade war threats. The Fed chair doesn't control any of this. These risks persist regardless of who's running the Fed. Force number 5, mining supply constraints. Annual gold production is about 2,600 tons. Declining ore grades, rising extraction costs, no major new discoveries. You can't just turn on a tap and produce more gold when prices rise. JP Morgan analysts said even modest diversification away from dollar assets could drive gold to 5,000 to 6,000. These aren't Fed policy variables, they're structural economic realities that support precious metals regardless of who sits in the Fed chair's office. The leverage unwind, what really happened now. Let me show you the actual mechanics of the January 30th crash, because this is where it gets wild. Gold didn't just rally to 5,600 on fundamentals, it went vertical on leverage, derivatives, paper contracts stacked on top of each other like a house of cards. Short interest in the silver ETF SLV fell to 0.7%, a 5-year low. Options volume in silver ETFs exceeded QQQ, the Nasdaq tracking fund. One analyst literally compared it to GameStop in 2021. Michael Brown at Pepperstone said, "The traditional saying of stairs up, elevator down doesn't apply here. This was elevator up, elevator down." The Walsh announcement provided the trigger, but the positioning made a violent correction inevitable. Real yields, that's nominal bond yields minus inflation expectations, hit 1.9% on 10-year tips. That's a meaningful alternative to holding non-yielding gold. Markets weren't granting gold and inflation acceleration premium anymore. Here's what's critical. By early February, gold had recovered from the crash low of 4,700 to trade around 4,850 to 4,900. That's a 3 to 4% bounce, but still 13 to 14% below the pre-Walsh peak. Silver recovered from 79 to approximately 85 to 87, 7 to 9% bounce, but still 28 to 30% below the 121 peak. Partial recovery suggesting the sell-off was overdone, but not a return to euphoria levels. The market's saying, okay, we overreacted, but we're not going back to crazy town either. Alright, let's talk about where this goes from here. I'm going to give you 3 scenarios: bull case, base case, and bear case. Each one depends on how inflation data prints over the next 90 to 120 days. Bull case, inflation remains sticky at 3%. Productivity gains prove real but insufficient to offset services inflation. Geopolitical tensions escalate. Central banks accelerate diversification. Walsh implements 3 to 4 rate cuts, bringing Fed funds to 2.75 to 3%. Real yields decline to 1.5 to 1.6%. Fiscal deficits widen to 7+% of GDP. In this scenario, gold reaches 5,200 to 5,500 by year-end 2026, silver 95 to 105. Not a return to peaks, but sustained elevated levels. Base case, inflation gradually declines toward 2.5% but remains above target. Productivity gains materialize modestly. Geopolitical risks persist but don't escalate. Walsh implements 2 to 3 cuts, reaching 3 to 3.25% Fed funds. Real yields hold 1.7 to 1.8%. In this scenario, gold consolidates 4,700 to 5,000, silver 82 to 92, elevated by historical standards but below January peaks. Bear case, inflation accelerates above 3.5%. Productivity gains fail to materialize. Walsh's hawkish instincts re-emerge. The Fed implements only 1 cut or none. Real yields rise toward 2 to 2.1%. Dollar strengthens significantly. In this scenario, gold falls toward 4,200 to 4,400. Silver toward 72 to 78. Continuation of the January 30th correction. The critical variable in all scenarios, inflation data. If core PCE and PPI remain elevated, Walsh's hawkish instincts will override his productivity thesis. His historical record is clear: fear inflation first, accommodate growth second. What this means for you. So what do you actually do with this information? First, maintain your core precious metals allocation. The structural case remains intact. The mechanisms supporting metals haven't disappeared. They've just changed from political capture risk to fiscal sustainability risk. Second, monitor inflation data religiously. Core PCE, PPI, wage growth. These determine whether Walsh's productivity thesis allows rate cuts or whether sticky inflation triggers his inner hawk. Next releases core PCE for January in late February, core PPI for January in mid-February. If these print at or above 3%, the bear case gains credibility. Third, watch real yields, not nominal rates. Gold moves based on real yields. Critical level, 1.9% on 10-year tips. Above that, metals face headwinds. Below 1.7, metals gain support. Fourth, distinguish corrections from trend reversals. The January 30th sell-off unwound extreme positioning and eliminated political capture risk. That's a correction. A trend reversal would require resolution of fiscal deficits, end of geopolitical tensions, and cessation of central bank diversification. None of those are happening anytime soon. Fifth, recognize that Walsh's institutional credibility reduces tail risk but doesn't eliminate inflation risk. The worst case, politically driven hyperinflation, is off the table. But fiscal inflation, supply-side inflation, and geopolitical inflation all remain very much possible. Conclusion and call to action. Here's the bottom line that everyone's missing. The question isn't whether Kevin Walsh will be more or less dovish than Jerome Powell. The question is whether you understand the difference between political capture risk, which Walsh's nomination eliminated, and fiscal sustainability risk, which Fed independence may actually intensify. Same destination, different mechanism. The fiscal deficits running 6% of GDP haven't disappeared. Central banks diversifying 850 tons annually haven't stopped. Geopolitical risks haven't resolved. Walsh will defend Fed independence, and that reduces one risk, but it means the Fed won't monetize fiscal deficits, and that intensifies another. The contractual vulnerabilities in paper gold markets, the 100-to-1 leverage ratios, the force majeure clauses, the registered inventory down 25%, those mechanisms remain active. So here's my question for you. Are you using this correction to add to physical positions, or are you reducing exposure? Drop a comment below and let me know your strategy. I'm genuinely curious to see how you're thinking about this. If this breakdown helped you understand what's really happening beyond the headlines, do me a favor and hit that subscribe button to Financial Historian Bamboo. If you found this valuable, smash that like button. If you disagree or think I missed something, hit dislike. Either way, your feedback helps me make better content. Remember, everything I just showed you comes from publicly available sources, Fed speeches, FOMC transcripts, market positioning data. This is educational content, not financial advice. I'm not telling you what to do with your money. I'm showing you how to think about what's happening. Until next time, stay sharp out there. This is Winston signing off.